picked up your quizzes, I have the last of the quizzes with me, so.
Once it's going to be undervalued,
So let's get started. As you well know, this is the third from last session, which means the last class is a week from today, which also means your project is due a week from today, 5 o'clock next Monday. There's really not that much left on the project after you've done your DCF valuation. It looks like I'm crying. It's not because of your project. My allergies are really bad. I was thinking of wearing sunglasses actually to this. But no. But it's I sent you the to-do list, so just go through it sequentially. There really isn't that much if you approach it systematically. And please do try to get me the numbers by Sunday. I'd say the earlier the better. Saturday, I would really love it by Saturday. If you can't get it by Saturday, get it to me by Sunday evening. Because on Monday in class, all we're going to do is look at what you found with your companies. What 10 most undervalued, 10 most overvalued, how many companies came out as under, how much came out as overvalued. You can get a picture at least of what you found. And I'll give you a sense of what previous classes, because I have 25 years of these project summaries that I can pull on. I'll show you what the previous classes have found. Yes, Alex.
So to be clear, the debt for if we're going to use the option value for equity and how to calculate, we're not taking into account the leases, operating leases, correct?
You can. No, there's no reason why not. It's the only reason you might hold back is in liquidation. What happens those leases? But if you have 80% debt and most of it is leases, you still have an optionality issue with your company. So no reason why you shouldn't. Okay. Any other questions? Okay. So the other thing I want to say is your final exam. There are two final exams. One is an early exam on Tuesday from 6 p.m. to 8 p.m. How many of you are planning to take the early final? Okay, I'll set up a Google shared spreadsheet so you can go in. It's really not an option. I mean, do it only if you have to do it. I'd prefer you take it on Wednesday because the evening class, I won't be here from 6 to 8, so I'll write the exam, obviously. The TAs will proctor the exam. But I'll set up a Google shared spreadsheet for people to pick. It's either Tuesday evening or Wednesday from 1:30 to 3:30. So you're not going to be spending that many extra days getting through it. It won't be the same final, so don't try to torture somebody who took the exam on Tuesday to see what they got, because it's going to be a different final. I can't even promise you it's going to be equally difficult or equally easy. There's just going to be two different finals. I will put up the final exam review session webcast by Thursday, so you'll have enough time to kind of review the stuff if need be. Okay. So let's start with today's topic. I sent you that pre-class test. I don't know whether you got a chance to look at it, but even if you did not, you should be able to kind of go along and do the test as we go along. So I'll give you some background on this particular session. About 10 years ago, a friend of mine who runs these executive seminars in New York City called me, and he runs these seminars for CEOs, CFOs, etc. And he said, "I'd like you to come in and talk at a seminar I'm running." And I said, "Well, what's the seminar for?" He said, "It's for serial acquirers. These are companies, you know who I'm talking about, companies that do acquisitions all the time. These are CEOs and CFOs of serial acquirers, and they're going to be at a conference, and I'd like you to come and talk to them." And I said, "Are you sure you want me to come and talk to them? Because my biases about acquisitions are well established." He said, "No, I really want you to talk to them, because for the rest of the day they're going to be hearing from investment bankers." You know what investment bankers think about acquisitions, right? It's the mother's milk of deal making. I mean, it's the greatest thing on the face of the earth. So he said, they're going to be listening to investment bankers all day, tell them how great deals are and how many deals they should be doing, and I'd like you to come in and give some counter to that at the end of the day. I said, "I'll be there." I said, "How late in the day?" Because I have this rule. Once the sun goes down, I'm not in the city kind of rule. So is it after the sun goes down or before? Luckily it was summer. It was 4 o'clock or something. I said, okay, it's pushing the limits on what I can handle, because once I get to 5 o'clock, my brain stops functioning. So I showed up and I put up my presentation, and people almost immediately knew where I was coming from, because this was the title I put up. I said, it's Acquirers Anonymous, 7 Steps to Sobriety. And here's why I titled it as such. To me, acquisitions are an addiction. Because once companies start to grow through acquisitions, it is very difficult for them to step back and go back to growing the old-fashioned way. You know what I mean by the old-fashioned way? You got to take project after project after project, and you got to build up over time. It's so much work and so much time. You want to do things fast. You do a big acquisition. You're in the news. Your ego gets soothed. Everybody talks about you. So once you start doing it, people almost hate to look at whether they're doing it right. So I'm going to start off today with some very depressing facts about acquisitions in general. And then we'll talk about what it is about this process that's screwed up. Because there's something really screwed up with this process, because there's no other way you can explain it. So let's start off with the first and most basic fact about acquisitions. There are two players in an acquisition, right? There's the acquiring company and there's the target company. So I'm going to make you guys the acquiring company stockholders. I'm going to make you guys the target company stockholders. Already you know which side you want it to be on, right? If there's a winner in this game, which side is it more likely to be? There's the target company, the red line. That's you guys. There's the acquiring company. At best you break even, and usually you tend to lose money. So that's the first piece of the puzzle. If you're looking at acquisitions, you'd rather be the target than the acquirer, because the target company is the one side that consistently seems to win. Of course, there are 2 other players who win consistently too. You know who they are? The bankers for the acquirer and the bankers for the target. So there are 3 winners, bankers for both sides, the target company. The big loser, of course, is the acquiring company stockholders. So I put this up, and immediately every hand goes up. He said, "You're not getting it." And I said, "What am I not getting?" He's saying, "That's what the market thinks at the time of the acquisition, but they don't see what we see." You know who the we is? The CEOs and CFOs. What do they see? They see projections about cash flows and wonderful things around the horizon, synergy and control and all that stuff. They don't know as much as we do. Now that statement is technically true. The CEOs and CFOs of the acquiring company do see a lot of proprietary data that the stockholders don't, right? So maybe the market's wrong. Maybe what we're observing at the time of so this is actually around the acquisition announcement date. Maybe what the market is doing is short term, because there is this conventional wisdom. Markets are short term. Maybe these guys are being long term. So then I brought out my hammer. I said, okay, maybe the market's wrong on the announcement day. If I track these acquisitions for 3, 5, 10 years after the acquisition, and if you're actually right about these acquisitions being good, then I should see the numbers, right? In what way? If you're talking about synergy, I should expect to see the combined company's earnings be higher, maybe 5 years. I'll give you time. You take your time. Take 3 years, take 5 years. I should expect to see higher earnings, higher revenues, higher growth post-acquisitions, especially if I give enough time. McKinsey and KPMG have been doing these studies now for almost 20 years. And the McKinsey studies go back almost to the 80s. And every time McKinsey looks at these acquisitions collectively, it asks a couple of questions. Okay? It actually has 3 questions. You tell me whether these questions seem harsh. The first is, the return on capital invested in acquisitions exceed the cost of capital? Is that a too harsh a question? I mean, this is what you ask about any investment, right? If you invest in something, are you earning a return that exceeds your cost of capital? Second, do these acquisitions help the acquiring company outperform the competition? Because if you're talking about synergy and all that neat stuff, you should do better. And third, when they looked at, actually there are only 2 questions. When they looked at these 2 questions and they looked across companies, they found that half of all companies failed at least one test and many of them failed both. KPMG in the late 1990s started doing these studies where they looked across thousands of acquisitions globally. And they asked a very simple question. Remember, in most acquisitions, the most used word is synergy, right? I think it's in 90% of all acquisitions, it's thrown into the mix as synergy. So KPMG asked a very simple question. If we track mergers 5 or 10 years after the merger, in what percentage of mergers does synergy actually show up? Does a combined firm's earnings grow faster than it used to before? And the first time they did the study, and the results have stayed pretty consistent, they found that in more than 80% of all mergers, there was no synergy or reverse synergy. You know what I mean by reverse synergy? 2 companies come together. The combined company actually does worse than the individual companies did before. And here's the final piece of evidence. If you track acquisitions over time and you look across the 10 years after an acquisition, half of all acquisitions are reversed within 10 years of the original acquisition. You know what again, reverse basically means you buy a company and then you say 6 years later, it didn't work, you sell the company off. So if you look long term after the deal, there is little or no evidence that mergers deliver the results that are promised. So at the time of the merger, bad things happen to the acquiring company's stock price. And in half of all acquisitions, the acquiring company's stock price drops on the day of the acquisition, and sometimes by significant amounts. And even if you track it for a longer period, there's very little evidence. Now here's a depressing afterthought. Until about 15 or 20 years ago, acquisitions went one way. Developed market companies acquired emerging market companies. That's the way it was. Because the developed market companies had the resources, emerging market companies were targets because these were big markets. So US companies would buy Indian companies, Brazilian companies, Chinese companies. And then the tide started to turn about a decade ago when you started to see Indian and Brazilian and Chinese companies get big enough to reverse the process where they were acquiring US or European companies. So Tata Motors acquires Jaguar Land Rover. Tata Steel acquires Chorus. So basically you start to see the process reverse. And here's the depressing finding. There are studies now that track Indian companies after acquisitions to see if maybe emerging market companies are smarter about using their money. Initially, when the acquisition is announced by these companies, the stock price tends to pop. A little of that has to do with patriotic fervor. You know what I mean by patriotic fervor? People are all proud about the fact that an Indian company is now buying a US company. A Brazilian company can afford to buy a European company. Everybody stands up and cheers, price goes up. And then it fades very quickly because by the time you get to 12, 13, 14 months after the merger and the numbers start to come in, the returns start to fade as well. So you look at the US, you look at Europe, you look globally, collectively there seems to be almost no way you can justify acquisitions collectively. Because collectively, these acquisitions, acquiring firms either pay too much upfront, or they overpromise in terms of synergy and control or all the other neat stuff. So that seems to be the overwhelming evidence you get across deals. But here's what's, I think, puzzling. The first evidence that acquisitions not work came out in the 1980s. You'd think people would read those and learn. Maybe we should stop doing. Then you look at the 1990s. People are continuing to do what they did in the 80s. Then you look at 2006. Same things. 2015. You go through this process. There seems to be no learning built into the process. 40 years after the first studies came out that acquisitions did not work, companies seem to keep making the same mistake over and over again. I know that's a definition of insanity. But to me, it's also evidence that there's something structurally wrong with this process that's kind of fighting against good sense. So what I'd like to actually do is take you through the process of valuing a target company, using you as guinea pigs to find those weak spots in how companies get valued in acquisitions. And as you go through this, you're going to see almost every weak link in acquisition analysis in practice. Before I do that, is anybody taking the M&A class? Or, anybody is? Right? I've always wondered how you have an entire class around M&A, and here's why. Valuation in M&A. Probably should take 2 sessions. You know what the rest of the session's about? Structuring the deal, selling the deal. It's all about the deal. And I think that actually opens the door to why I think acquisitions go bad. Is the deal becomes so much front and center that people stop asking the question, what's the most significant question in an acquisition? Not did I pick a target company? And in other words, it's the price. If at the right price, I don't care who you buy. At the wrong price, I don't care who you buy. But we spend so much time finding the right fit. See, it's like getting married. This isn't getting married. This is, you're actually paying a price. It's an economic transaction. So you call in the strategist and they come in and say, you get this. This is the best mix for you. You spend 80% of your time, 90% of your time getting the right fit. But if you overpay, who cares? So I don't care if you have the wrong fit, if you got it at a bargain. Or if you get the right fit but you overpaid. So here's what I'm going to do. I'm going to talk about 7 potentially dangerous things that happen in valuation, but I'm going to use a very simple company to illustrate the process so we don't get lost in the details. I'm going to start out with what I call risk transference. For the moment it'll sound abstract, but as I go through the example you'll see exactly what I'm talking about. I'm going to talk about the process by which acquiring companies try to endow target companies with characteristics, risk characteristics that they have. So they're safe. They think everybody they look at can also become safe. The second is what I call the debt subsidy process, which I've talked about earlier, but I want to come back and talk about it. Which is if you're an acquiring company with access to cheap debt, you're a AAA rated acquiring company and you use that cheap debt to value a target company, you're going to overpay for the company. Third, I want to talk about control. In acquisitions, it's standard practice to often do a valuation and add 20%, 25% for control. I want to talk about what exactly are we doing this for? Where did that 20% come from? And when is it appropriate to pay a premium on an intrinsic valuation to get control of a company? Fourth, I want to talk about synergy. I'm going to dispel this canard that in finance we think synergy is worth nothing. No, synergy can be worth a lot. It's just that you have to pay the right price for synergy. You've got to attempt to at least value the synergy. I want to talk about synergy. Fifth, I want to talk about pricing in the context of acquisitions. I want to talk about how people price target companies rather than value them, and how that pricing process can get us all into trouble. I mean, I'm going to talk in particular about what I think is one of the most insidious practices in acquisition valuation, and it's called transaction multiples. You know what transaction multiples are? Basically, you look at other companies that have done acquisitions, you look at what prices they pay, and you feed what they pay into what you pay for a target company. Then I want to talk about the fact that in many acquisitions, the deal seems to have been decided on first and then the analysis follows. Very common. We talk about bias in the process. How the process is so biased that's almost impossible to take an honest view of the deal. And finally, what amazes me about even the worst acquisitions ever made is nobody seems to be accountable. Nobody. I'm talking about CEOs of companies, bankers. You do a $50 billion, you make a $50 billion mistake, somebody should be fired, right? But nobody seems to lose their jobs. So let's start this process off, and here's what I'd like you to do, and I'd like you to be as honest as you can with yourself as we go through. Anybody planning to go into M&A after this? Okay. Okay, so here's I'll make a deal with you if you want. If you fail more than 2 of these 7 tests, I'd like you to reconsider. I offered this to the CEOs and CFOs, and none of them took me up. If they had, I think 3/4 of that group would have failed and would have had to drop out. So at least to yourself, to thine own self, be honest. So as we go through, just check offs, right? So whether you passed or failed the test, as we go through, you can go through this. And what rationalization you might have. You might have a really good reason why you picked the wrong answer. Write it for at least for yourself to read. Don't send it to me. I'm not interested in your rationalization. Okay? So let's set the game rolling. As I said, I'm going to keep this process simple because I want you to focus on the things that can go wrong. So you are the acquiring company. I come to you with a target company. This is what the target company looks like. The revenues are 100 million. The operating expense was 80 million. Operating income is 20 million. Taxes are 8 million. After-tax operating income is 12 million. So that's what they look like right now. Let's make this a really simple company to value. Let's assume this company will generate $12 million in after-tax operating income every year in perpetuity. 0 growth. The company has a cost of equity of 20% and no debt outstanding. So what is its cost of capital? It's also 20%. What's the value of this target company? Forget about the acquisition. If I came to you, this target company is a standalone company, what's the value of the company? 60 million, everybody have that? Right? 12 million divided by 0.2 is 60 million. It's a perpetuity. So I want you to hold on to that number because now we're going to make this the target of an acquisition. You're the acquiring company. You're a very safe acquiring company. Your cost of equity is only 10%. Remember the target company I showed in the previous page? How much is the target company worth to you? You see the question I have. Is it still worth 60 or is it worth 120 million now? Jonathan, what do you think? So you wouldn't pay the 120, but your cost, it's your money that's being used for the acquisition.
The cost of equity should be outpaced of the risk of that company.
The risk, it's a capital budgeting 101. The discount rate for a project should reflect the risk of the project, not the risk of the entity looking at the project. First rule in acquisitions, you cannot use the acquiring company's cost. We remember the Kennecott Congolium case, right? We did this way back. Half of all acquisitions, you see the wrong company's cost of equity used in the acquisition. I don't get this. Maybe I do in some deep sense, but I try not to even look at that deep sense. It just doesn't make sense to me. Somewhere along the way, something's been missed if you're using. In fact, let's carry this to its logical limit. If I, as a safe company, decide to use my cost of equity to value target companies, what am I going to be doing? I'm going to not only overpay, I'm going to buy every risky company. It's going to look cheap to me, right? I'm going to keep acquiring companies telling the world, look, I got a deal, I got a deal, I got a deal. And 5 years later, what's going to happen? Everything's going to blow up in my face. Eh? That's exactly what happened to AT&T in the 1990s. In fact, you can look at the histories of companies and you look at acquisitions, and this is the way many companies get into trouble, is they use their cost of equity on this very misguided logic that it's our money, therefore we'll use our cost of equity to value the target company. So I'm going to assume everybody here passed the test, because by now we've done this so often that I would assume that everybody just kind of gets that you can't use the acquiring company's cost of equity to value the target company. So everybody with me so far? Now let's make it a little messier. Let's assume you as an acquirer, have access to cheap debt. Remember, the target company has no debt, but you can borrow money, and you can borrow money at 4% after taxes. And you plan to borrow half the money for this deal from debt. You see how the mechanics are going to kick in now, right? Already thinking cost of capital. I'm saying 50% comes from debt, 50% comes from equity. Even if I don't unlever and relever betas, the equity, even if I go back to the target company's cost of equity, 50% of 20% is 10% plus 50% of 4%. So basically the cost of capital then should be about 12% rather than 20%, right? which would make my target company worth $100 million. Can I do that? I mean, this I'm not breaking some capital budgeting rule. What might be your concerns with my doing this? But what are the questions you need to ask me before you let me do this? Where's the drop in cost of capital coming from? The fact that I can borrow money at a really low rate, right? Why am I able to borrow money? Because I haven't borrowed in the past. I have debt capacity. I've been very conservative. I've managed my company really well. And so basically I'm going to give you a higher value because I had debt capacity. In fact, I'm actually paying you a premium for something you had absolutely no role in creating. There's one escape hatch where I can use a debt ratio on the cost of the target company. Can you tell me what that escape hatch is? When might I be able to borrow money to buy a target company and use that debt ratio in my cost of capital? What's got to be true about that debt? Or they had debt capacity that they did not use. If the target company had the capacity to borrow 50%, it chose not to use it, and had the capacity to borrow money at 4%, then I'm really not using my debt capacity and my cost of debt. I'm using the target company's excess debt capacity. You just opened part of the door to the value of control. Because by you running the company, but if it's your debt capacity and your low cost of debt, you should not be passing that on to the target company stockholders because they had absolutely no role in creating that additional value. So it's a general principle. That's something you need to remember, is every time you put something into the cost of capital and push up the value, you're then paying as a premium something that doesn't belong to the target company stockholders. Can you imagine how much subsidy GE is left on the table over the last 25 years? Because GE consistently uses its cost of equity to acquire target companies. It uses its debt ratio and its cost of debt in the cost of capital calculation. And if you add those things up, think of the premium you end up paying on company after company after company. Joseph?
But that's a scenario, if that's similar to the process of LBO, like using companies'
Yeah.
debt capacity.
Well, be careful. The L in the LBO is a very dangerous thing, right? Because in an LBO, you're not going to just your optimal. You're shooting your optimal. You're going way up on the... So it's like a cost of capital graph. You're going right through it and going to the other end. It's a reason for leveraging a company which has the capacity to borrow money. But I would separate the L from the BO, which leaves you with the BO, I guess. Because all too often, the BO part of the LBO actually makes more sense than the L part of the LBO. We're talking little acronyms here. But you know what I mean? For some reason in private equity, L, B, and O get stuck together. And it's a point I made when I gave you the mystery project and asked you to target a company. You can target a company with no debt capacity and use all equity to do the acquisition. But if you use leverage, it must be because the company had the capacity to borrow money, I hope. Because if you're borrowing money in a company that doesn't have the capacity, you're playing with fire. Any other questions on the debt capacity and the cost of debt? So that's the second stop along the way, is making sure you use. So to value target company, then you need to use its beta, its debt capacity, its cost of equity. You almost have to value the target company as if it were a standalone company. That's what I'm saying. Is any kind of subsidy you bring to the table, you shouldn't be paying as a premium. So keep the subsidy for yourself because it has nothing to do with its target company. Third stop. Let's talk about control premiums. I first remember about 24 or 25 years ago when I first saw this done, I was staggered. I saw a DCF valuation, and then at the end of the process, after all of this work, the analyst just added 20% to the value. And I said, what are you guys doing? He said, we're adding a control premium. And I said, for what? For control. I said, what does that mean? He said, control. That's it. You keep going back and forth. Control. I've never seen dividends paid with control. I mean, the control has to manifest itself somewhere. So then I started digging about where this 20% comes from, because it seems to be like a constant over time. And the 20% actually comes from a database maintained by a service that used to be called MergerStat, but it's still around. There are other services that carry the same data. And all merger stat does is it keeps a historical database of every acquisition, and the 20% is actually, roughly speaking, the average premium paid over target companies' market prices by acquiring companies. So the 20%, roughly speaking, is the premium that acquirers have paid over history to get acquisitions done. So I said, okay. Now what's in that 20% then? So this is what people pay over the market price. Some of it might be control. What else is in there? If there's synergy, it's in there. What else? Subsidies. How about stupidity? If you overpay, where else does it go? It goes into that premium, right? So the 20% you observe could be synergy, it could be control, it could be, whatever, and it could be overpayment. It's all in the 20%. So if I take that 20% and add it on as a control premium, think of how dangerous this game becomes, because then, assuming you paid for synergy, you add more for synergy, that's double counting the synergy. If there's no control, you paid for something that doesn't exist. So what I'm saying is, don't add a 20%. I know it's established practice, but just because everybody does it doesn't make it right. So let's step back and think about what the value of control is. And to set it up, let's take that company I showed you, that 12% after-tax operating income on $60 million in revenues, right? 20% margin. But let's say you think that this company is not very well run. That you think you can come in and change the way the company is run and improve the margin to 30%. So holding everything else constant, that $60 million company now becomes a 12 million becomes 18, so 18 becomes a $90 million company, right? In other words, it's almost magical. You've made the 60 million to 90 million by running the company more efficiently. What's the value of control of this company? 50%, right? 30 million. But let me now ask you the pragmatic question. You plan to change the way this company is run, right? And based on your plans, you think the company could be worth 90 million. So should you pay 90 million on the acquisition? In fact, if you pay 90 million to the target company for the acquisition, what have you just done? You paid a premium to target company stockholders for hard work that you will have to do after you take over the company. So even after you value control, you know what the next step is? Figuring out how you keep a portion of that control for yourself, because that's the name of the game. It's not to change the company and pay off the entire premium. It's that I want 40, 50, 60% of the premium. You're saying, why doesn't it happen more often that we see that bargaining? To do it, we have to value control explicitly, right? Because if I just leave it as a fuzzy 20% out there, I have no idea what I'm getting as a person of control. So we will actually more explicitly talk about control in the next class. When we talk about value enhancement, we'll talk about value and control. But I think that control has to be valued if you're going to pay a premium for it. Because if you have a perfectly managed, perfectly run company, you know what the control premium should be? It should be 0%. So when we talk about control, we have to talk about cash flows and growth and risk and how those will change. Joseph?
I've heard control and synergies used interchangeably.
Yeah, here's the difference, and it's actually good that you raised this question. Does somebody want to actually address it? The question is, there's in acquisitions, your control and your synergies, and they kind of swim together. People almost use them interchangeably. How would you distinguish between control and synergy? What's the difference? There is a difference. In fact, you can draw the line. Control stops here, synergy starts here. You want to try? Yes.
Because with synergy, it has to have an effect on your existing company, whereas control is solely focused on the target.
That's exactly it. If control doesn't require another company. So here's a way to think about control. Act as if there's no acquiring company in the middle. Say, if this target company were perfectly run, how much value could I create? You don't need an acquirer. You don't need an acquiring company. Synergy, by definition, needs two companies. So in fact, when I value acquisitions, I do it in 3 steps. I value the target company status quo. You know what I mean by status quo? The existing management running the company. Then I revalue the target company with what I think of as optimal management. Best debt ratio. The difference between the two values will be my value of control. Now I have the value of the target company optimally run. Then I bring in the acquiring company. Say, what are the synergies here? With the optimally run target company. So that might be higher revenues, new markets I can capture, That increase in value is my synergy value. And the reason I want to separate the two is what percentage I demand of each will depend on whether because control, almost by definition, I should be trying to get the most I can because I made the changes. Synergy, almost by definition, will require that both the acquiring company and the target company try to get a share of it because they're both needed. So we'll talk about how to divide up those spoils. But that's a dividing line. Control does not need another entity, another company in the mix. Synergy always needs another. That's why in an LBO you can have, it's all control, right? There's no other company. It's just the private equity agent coming in and changing the way the company is run. But synergy always needs another enterprise out there. Right? Any other questions? So don't fall for these rules of thumb. Just because everybody uses 20% control premiums does not mean that you should be adding it to. In fact, I was asked to give a talk to the Delaware Chancery Court judges a couple of years ago. And these guys, I mean, this is all they do, right? All these acquisition cases come in at UPenn. So it was about control premiums. And the reason they were there, one of the reasons they wanted me to talk to them is they were getting increasingly frustrated with bankers coming in with 22%, 24%, backing it up with this merger stat date. And the question they were asking was, what are the questions we need to ask these bankers when they add a 24% premium? And I said, okay, I'll give you a list of questions. I hope I've made life difficult for bankers. It's my life's ambition anyway, right? So, because I think those are the questions you need to ask. A banker gets up and says, I'm adding a 24% premium. You need to ask, what are you changing in the company? So what do you mean? Well, if you're not changing the company, where's the 24% coming from? We want to see something explicit, okay? And that's really how we have to start thinking about control. Not in terms of rules of thumb, but in terms of what the company was. Remember that envelope test we did? I put control in there. I didn't add to the $20. You have to really think about what it does to your cash flows, growth, and risk. Now let's talk about synergy. If you think about the definition of synergy, it's very, very clear. Synergy reflects the value of things you can do as a combined company that you could not have done, this is key, as standalone companies. It's amazing how often people mix up things that are not synergy with synergy. You hear people talking about improving inefficiencies in a target company. That has nothing to do with synergy, right? Because anybody can fix it. You don't need an acquiring company. So synergy by definition needs an acquiring and a target company. So let's talk about where synergy comes from. All too often when you see two companies come together, you'll see people casually talk about synergy because the combined company is going to be safer than the two individual companies going in. And that's almost always going to be the case. Combining two companies, especially if they're in different businesses, will make them safer. But you know what? That's safe. Making them safer will not make them more valuable. That sounds almost contradictory, but how do you reconcile the fact that combining two companies makes them safer, but it might not increase their value? It makes them safer in what sense? When you combine two companies. We did this in the context of options, if you remember. Bring two companies together, what happens? The covariance within the companies is, the correlation is less than 100%, especially in different businesses. A combined company is going to have a variance less than the two companies that went in, almost by definition. You're saying, why isn't it increasing my value? Very simply, it's not increasing my value because when I value the individual companies, I value them based on the presumption that the only risk I should be building into my cost of capital is the risk that you cannot diversify away, which is what beta measures. If I'm computing cost of equity and capital based on risk that cannot be diversified away, you can do as much as you want about eliminating diversifiable risk, which is what you're eliminating with mergers. It's not going to make my combined company more valuable. And here's the intuition. If a steel company buys a chemical company and claims to have created value, your response as a stockholder should be, I could have bought that steel company and the chemical company separately, put them both in my portfolio, and I wouldn't have paid 30% premium to do it. So when you talk about reducing risk, you have to ask that follow-up question. What kind of risk are we talking about? You know, again, the one exception to this rule? Two public companies coming together, there can be no value created from combining the companies, because the investors in that company, those companies could have been diversified. But if two private companies come together, do you see the potential benefit? We talked about valuing private companies. There, what did we do? We looked at total risk rather than market risk. And this is actually the third problem on the last quiz, right? Where I combined two private companies, and the combined company was more valuable, not because I did any magic, but because a correlation of the combined company was much higher with the market. It's an argument for conglomerates, especially at private business levels, because you can actually get the savings. But if you're talking about public companies, you almost never, or you very seldom get synergy benefits show up in the discount rate. Combining two public companies. But synergy benefits can show up in your cash flows, right? They can show up as new markets, potential revenues, higher market share, higher growth. So if we're going to talk about synergies, that's usually where it's going to show up, either as higher revenues or lower costs and therefore higher cash flows. And the value of the synergy then becomes what you bargain for in an acquisition. Let's set up the process. You're the acquiring company, you're the target company. I switched roles because I don't want you to be the ones who always get punished because of being the acquiring company. Let's say the value of synergy in this merger is $1 billion. Let's say you've been realistic, you projected revenues, margins. So you think you can create $1 billion. How do you decide how much goes to each side? What's going to determine whether you get 800 and they get 200, or you get 200 and they get 800? Obviously, both of you contribute to the synergy, right? So it seems like both should get 50%, right? So, but why is that not going to be the case? What's going to determine who gets a bigger share of that billion? Yes?
The negotiation process?
And what in the negotiation process is going to give one side more power than the other?
Depends on who has more bargaining power for, if there's a lot of potential acquirers who is
Exactly. It depends on where you're both bringing in skills. So let's say your skill is you have lots of distribution network and you have a great product. And the synergy is going to come from combining the two. It depends on which side is scarcer, right? If there are a dozen companies with great distribution networks and only one company with great products, you are in the driver's seat, you're going to get a much larger share of the synergy. But if you're the only game in town in terms of distribution networks and there are a dozen companies with good products, you're in the driver's seat. So it is true it's a negotiating process, but it is something that's got to be based at least fundamentally on which side has the scarcer resource. But to do that again, you have to value synergy first. So let's talk about valuing synergy. When I think about valuing synergy, I always think about some number in my valuation that has to change, right? Because ultimately, it's got to show up in the numbers too.
Sorry, going back to an earlier discussion we had,
Right.
private public transactions or private
Right.
transactions. If there are a lot of private companies that offer the same service that the acquirer offers, that the public acquirer offers, the public acquirer would still have the advantage, right? Because
That's in the marketplace because they need a lower cost of equity. They can sell their stuff at a lower cost. They can settle for lower margin. So it'll show up in the product marketplace, right? So when you compete for the customers, the public company can knock its prices down more because it doesn't have to make a 20% return to break even. It has to make only 11% return. So if you're competing in the same product marketplace, you either have to sell yourself to the public company or go out of business, right? So that's the way it's going to show up in the competition. It's not going to show up in this stage in the process of acquisitions. It's really going to show up at the point of who ends up winning the market share in the market. Okay. Now let's talk about valuing synergy. I've taken every conceivable synergy that I can think about, and if you can think of more, just tell me what they are and we'll put them into the list. When I think about synergy, there are two kinds of synergy, broadly speaking, that you can be talking about. The first is operating synergy, and the second is financial synergy. Let's start with operating synergy. The operating synergy that is easiest to value is economies of scale. What kinds of mergers are you going to see these most frequently? It's going to be?
robots.
Or mergers of two companies in the same business in general, right? Because when you're talking about economies of scale, you're really talking about some kind of cost that runs across the companies. In roll-ups, it could be a distribution, advertising, some cost that you cut across companies, but it's going to be a reduction in cost. And you know why it's easy to value? What do you have to show in your DCF valuation? You have company A, company B, revenues, operating expenses, operating income valuation, revenues, operating income, operating expenses valuation. Then you have the combined company. The revenues are not going to change, right? It's revenue company A plus revenue company B. You get the combined company's revenues. But when I add up the expenses of company A and company B, that's where I'm going to stop and say, well, how much do you think you can save? You say 60 million. I'm going to knock down the operating expenses by 60 million, which is going to do what? It's going to push up my operating income by 60 million. And it's going to have ripple effects. In what sense? Having a higher operating income will push up my return on capital. Having a higher return on capital will allow me to either get a higher growth rate or reinvest less for the same growth rate. But it's easy then, once you've got that operating income readjusted, to do the rest of the valuation. So economies of scale show up as lower costs, higher margins, higher cash flows. You're done. The tougher operating synergy are what I'm going to broadly categorize as growth synergies, because they can show up in one of three places, or all three. They can show up as higher returns on new investments. As a combined company, you're able to earn a 15% return on capital rather than a 12% return on capital on new projects. How is that going to help you? If I increase the return on capital for the company, for any given reinvestment rate, I'm going to grow faster and create more value. So the same reinvestment rate will have a higher growth rate and a higher value. So the first is higher return on capital. The second is maybe your return on capital doesn't change, but you can take a lot more projects than you used to. You have a higher reinvestment rate. So higher reinvestment rate, same return on capital, higher growth, higher value. Or maybe there's a third scenario. Return on capital doesn't change, your reinvestment rate doesn't change. But remember, value is created by what? By whether your return on capital is higher than your cost of capital, right? Which comes from what kind of competitive advantages do you have as a company? Maybe by combining these two companies, you are able to create barriers to entry that allows you to earn those excess returns for a longer period, which means you can grow for 10 years rather than 5 years. Again, if you think about what I'm trying to do, I'm trying to find a number that I can change in my valuation. Is it going to be return on capital? Is it going to be reinvestment rate? Is it going to be the length of the growth period? And all or any of those numbers can change and create higher value for the combined company. That's basically economies of scale. Right? It's the same thing, right? When you get a higher return on existing investments, what are you saying? No, you're getting, no. So basically it's going to show up either as an increase in the operating income right now, and we can call it whatever we want. We can call it economies of scale, we can call it inefficiencies being removed, or it's going to show up as better growth in the future, more valuable growth in the future. So those are operating synergies. Any questions on operating synergies? Let's talk about financial synergies. The financial synergy whose name never gets spoken is tax benefits. In other words, if you have an acquisition that is predominantly driven by tax reasons, never ever bring it up. You know why, right? Because the minute you do it, you're actually in a very, very dangerous place. Tax authorities in almost every country are very clear. A tax-motivated transaction is going to get challenged. So if you have tax reasons for your acquisition, act like it's an accident. Oh, I never thought about that. Going to Canada reduces my tax rate? Oh my God, that never crossed my mind. Because here are the different ways you can benefit in terms of taxes in an acquisition. It could be that you're able to write up the values of your assets. So how does that help me? My book value goes up. Well, remember, if I write up the values of my assets, I might be able to get more depreciation in the future, which in turn reduces my taxes, and so it could be that. It could be that I'm a money-making company buying a money-losing company. This used to be the classic example that would be given for tax savings. You see where the savings come from? You have a money-losing company and a money-making company, you combine them. Think of how much you saved in taxes right away. The only problem is the IRS and other tax authorities recognize this right off the top, and they make it as difficult as possible to create mergers where you get tax benefits from combining a money-making to a money-losing company. But if there's that opening, you can exploit it. There are also very specific features in some tax codes that you might be able to exploit for acquisitions. I might have mentioned this before, I'm pretty sure I have, that in Brazil you have this interest on capital tax reduction. Have I mentioned that? Basically, in Brazilian companies are allowed to take their book equity and they're given an interest rate that's set by the government every year. It's 12% this year, for instance. They can take their book equity times 12% and claim it as a tax reduction. It's the Brazilian government's way of trying to give equity a tax benefit to kind of offset the tax benefit given to debt. But it has this one side effect, which is when you do an acquisition, guess what happens to your book equity usually? It becomes much bigger. Now if I take 12% of that much bigger number, I get a much bigger tax benefit. Now Ambev, which is Latin America's largest beverage company, is now part of a Belgian brewer called InBev. Very confusing, InBev, Ambev. But at the time that the original deal got done, there was a $2 billion premium paid, and it was estimated that 1.2 of that $2 billion came purely from this interest on capital deduction, because essentially the company is able to write up its book equity and get a much bigger tax deduction. Oh, here's the other. Among the EU countries, Spain remains alone in being a country that allows companies to deduct amortization of goodwill for tax purposes. You see how that helps in acquisitions? In the US, you do a big acquisition and I impair goodwill. There's nothing, no benefit you get. So you could write out $50 billion in goodwill. It's not creating $1 in tax benefits. Spain, among the EU countries, you can actually claim a tax deduction for a big chunk of impaired goodwill or goodwill written off. Another tax benefit you get from acquisitions that you otherwise wouldn't have. So if there are tax benefits, they effectively show up as a lower effective tax rate, lower taxes over time, higher cash flows, higher value. The second possible financial synergy might be that you have two companies that right now are optimally levered. You know what I mean by optimally levered? They should be at 20%, they're at 20% debt ratios. The combined company, because it is lower risk, remember that total risk going down, is now a safer company and is able to borrow 30% rather than 20%. That's additional debt capacity created by creating a safer company. It's one reason why having a safer company might help you. It's a way we counter actually the option problem, right? Because you combine two companies and they become safer. Remember how lenders walked away with the benefit at the expense of equity investors? This is how you claw it back, because you push your debt ratio up. Higher debt capacity pushes up the value of the firm, lowers your cost of capital. And finally, with private companies, you do get that benefit of diversification. The total beta for two combined private companies is going to be lower than the total betas you saw for the individual companies. So if anybody mentions the word synergy, you see a new story with acquisitions with synergy thrown in, what I'd suggest you do is take a look at what they're talking about and say, where would I see this, or where would I put this in my valuation? If I were valuing, so right now, for instance, a lot of pharmaceutical companies are going through these huge acquisitions, $40 billion company buying a $30 billion, and synergies floating around. I don't know whether it's merited or not. Start out thinking about, where does that synergy come from? Is it in the cash flows? Is it in the growth rate? Where would I show it in my valuation? Because if you don't show it in the cash flows, you don't show it in the growth, and you don't show it in the cost of capital, guess what? It's just not going to show up. Okay? Any questions on so here's what I'd like to do. I'd like to set up a process for valuing synergy. That's a pretty straightforward process. So you come to me with a merger and say, I want to value synergy. Here's the process you have to go through. Value the target company and the acquiring company as standalone companies. In fact, if any banker claims to value synergy and all you see is the target company valuation, there is no way you can value synergy with just the target company. You have to bring the acquiring company into the mix. So you've got to value the acquiring company, value the target company as standalone companies. If there's no synergy, because NPVs are additive, the value of the combined company should just be the sum of the two companies you've just valued. Then you get to part C and you can go to town. You can throw in every synergy you can think of: higher growth, lower costs, more debt ratio. Value the combined company with all the things you think the combined company can do. If you're right about synergy, the value you get in part C should be greater than the value you got for the standalone companies. That difference becomes the value of synergy. It sounds complicated, but actually it's a very straightforward process. Value the target, value the acquiring. There's no synergy. The value of the combined company is just the sum of the two. But then value the combined company with the higher growth, the lower cost, the higher debt ratio, whatever else. And what you get as the difference is the value of synergy. And if you have to wait for the synergy to be delivered, you know what I mean by wait? You bring two companies together. You almost never get synergy overnight. You might have to wait 3 years before it shows up. How would I reflect that? Once I value the synergy, if I have to wait 3 years, what should I do? Just discount it back 3 years at what? At what discount rate? Think about who the synergy accrues to, and the answer should kind of pop out. It accrues to the combined company, so the discount rate I should be using should be the combined company's cost of capital. And this is one of the few times when you actually think about the acquiring and the target company's cost of capital put together, because synergy is not just the target company's value created, it's not just the acquiring companies, it's a combined company. So it's an incredibly flexible process. You can value pretty much any synergy you run into if you follow that process. So let's try some synergies out. Let's start with the delusion of, hey, I've combined two companies, I've got lower risk, everything's going to be fine, my value just went up. The reason actually that's not going to happen is the way you compute cost of equity and cost of capital is based upon the risk that cannot be diversified away. On the assumption that investors in your company are already diversified, there is no value created directly from creating a safer company by combining two risky companies. This was the fatal flaw in the conglomerate strategy, right? Because in the 70s and the 80s, corporate strategists pushed conglomerates, saying if you create a conglomerate, it will be safer. And they were right. It was safer, but it wasn't more valuable. And they said, what the heck happened? Finance is failing. We could create a safer company. Nobody's paying us a premium. The reason nobody was paying them a premium was that you could have created a conglomerate on your own or just bought a mutual fund. I mean, think about buying the S&P 500 index fund. You created the most valuable conglomerate on the face of the earth, the most diversified company, and you didn't have to pay a dime in premiums to do it. So that first notion that combining risky companies to make a safer company and creating value is almost impossible to justify if you're talking about public companies. Now let's start talking about real synergies. About a little more than a decade ago, Procter & Gamble bought Gillette in one of the biggest mergers of all time. Procter & Gamble at that time was the largest consumer product company in the world. Gillette, I think, was the sixth largest consumer product company in the world. And the reason I picked it as my synergy example is that's all that you heard about, is how much synergy there was going to be by combining these two companies. So I decided to value synergy at the time the deal was put together. And remember the process. I first valued Procter & Gamble standing alone. Forget about this, the acquisition. Just act like it's a standalone company. The value that I got for the company was $221 billion. Then I valued Gillette standing alone. Traditional DCF valuation. I got $59.9 billion. If I just pause there and think about creating a combined company, if there's no synergy, the combined company, which I chose to call Piglet, just Procter & Gamble, that's not what they decided to call themselves, but I thought it would be a great name for them, Procter & Gamble and Gillette put together. But with no synergy, the value of the combined company just be the value of the two companies put together, right? And then I did a best case valuation of synergy. Let me explain why I'm going to call it best case. Because I took everything managers said they would do in this merger and assumed it would happen instantaneously. So they talked about cutting costs by $250 million. I assumed it will happen tomorrow. They talked about a higher growth rate. I said tomorrow we wake up to a higher growth rate. So a slightly higher growth rate, $250 million cut in costs, my value increases to $298 billion. Is synergy worth a lot? Absolutely. In this merger, it's worth $17 billion. But that's a best case valuation of synergy. If you have to wait 2 years, that value drops to $14 billion. If you cut only $200 million instead of $250 million, the value drops even further. But here's the number that should scare you. You know how much Procter & Gamble paid as a premium for Gillette? $25 billion. And then we wonder why so many deals don't work out. You have a $17 billion best case valuation for synergy and you pay $25 billion. How the heck are your stockholders going to walk away from this deal with any value added? But that's what happens when synergy becomes something you throw on the table after the numbers have been worked out as a way of justifying a deal that you really want to do. So if there are actual synergies, put the numbers down, value them, and then look at what's being paid as a premium. Because as I said, at the right price, synergy can be worth a great deal to your stockholders. At the wrong price, I don't care how much synergy there is, you're still going to walk away a loser from this deal. Next type of synergy, and this is one of those synergies that of course you're walking that gray line of taxes. But it's actually one of the most common emailed questions I get about synergies. Let's see if you can help me negotiate an answer to this. So let's assume that you're Best Buy and you're a reasonably healthy company. You know, nobody's reasonably healthy anymore, but let's say you're reasonably healthy. You're buying Zenith, which is a basket case that has no products, but its most valuable asset is the fact that it's lost a lot of money for a long period. You're saying, why would that be a valuable asset? Well, let's say they've accumulated $2 billion in net operating losses from previous years. So what are you buying? US Best Buy are buying a $2 billion NOL. I'll tell you in a minute why the IRS might put some roadblocks in here, but let's assume you can buy the NOL. I want you to value the tax benefit I get by buying this NOL, and I'll give you a tax rate. Say your tax rate is 36%. You're buying a $2 billion NOL. What's the value of that NOL? If I can get the entire tax benefit immediately, it's 2 billion times 36%, which is 720 million, right? That's the way most analysts value NOLs. They take the NOL, they multiply by a tax rate, and they add it on to the valuation. Here's the problem with doing that. Let's say Best Buy has only $500 million in expected operating income every year for the next 4 years. Right? Let's say expected operating income. What's the value of this NOL? It's less than 720, but let's work out the mechanics. How much am I going to save in year one? 36% of 500, which is 180. I still get the 720, but it's spread over 4 years. The value of the 180 million every year for 4 years is to reflect the time value of money, and what else? Am I guaranteed the 500 million in operating income every year? No, it's an expected number. It could be different. I could lose money, I could make money. And how do I capture that risk? By using a cost of capital for which company? Zenith or Best Buy? It's Best Buy's operating income that I'm uncertain about. Again, when in doubt about what discount rate should I apply, go to what you're uncertain about. You're not uncertain about the $2 billion NOL. You know exactly what it is. There's no uncertainty there. The number you're uncertain about is the operating income at Best Buy, and that number's risk is captured by the cost of capital for Best Buy, which means you discount the 180 million back 4 years at the cost of capital of Best Buy. You're going to get about 580 or 600 million as your present value. Saying what happened to the other 120 million? Time value of money and risk. And the riskier your company and the longer you have to wait for an NOL to get collected, the less valuable it becomes, but it's already embedded in your cash flows. That's why when I valued the young high growth companies that were money losing, I actually incorporated my NOLs into my cash flows, because that way I'm capturing it right away. I don't have to wait till the end and try to fix it, which is what a lot of people try to do in DCF valuations with NOLs, is separate them from the valuation, but they shouldn't be separable because they're tied to the operating assets of your company. Here's what the IRS has done to make this more difficult. It's actually made it more and more difficult for you to take operating losses at a company and claim it against the income in another company. You got to jump through all kinds of hoops to do this. And you can see why, right? Because otherwise you're going to buy shells of companies which have nothing but NOLs, and you're going to use those NOLs to reduce taxes paid. So there are all these little things you got to jump through, and by the time you finish jumping through them, my guess is you're going to have a really tough time to buy an NOL from another company and try to use it against your income. So if you're doing a tax benefit merger, make sure you check out whether you're able to use. So don't assume it can happen, because it might not. Okay? You've seen, at least on a bigger scale, this happen with the inversion stories in the last year. There's many a slip between the cup and the lip, between you announcing it and then it, no. And that's, I think, what you got to factor in when you think about synergy coming from tax benefits. Yes?
Could you do the reverse of that? Could a company, like a shell company with a lot of NOLs purchase a
money-making company? You'll have the same issues, which is the loss has to come from the same assets from which the income comes from. That's the IRS test. So what they're going to say is, you created the loss using a different business. Now you're acquiring assets that come with their own income. When you try to put them together, you're going to run into some kind of pushback from the IRS saying it's a very simple rule. If a transaction is primarily tax motivated, which is what this transaction is, you can almost guarantee that there's going to be a pushback. Doesn't mean the IRS will win, but it will push back. Yeah.
What if the combined company combines the operating assets and the parent?
Well, the problem is if you have an NOL and you have, in the case of Zenith, you have nothing, right? I mean, those operating assets have to generate enough income. So the IRS will push you on that. So when you claim the combined company's income is $500 million and the other company came in losing $300 million, you came in making $800 million, the IRS can act like anybody else and they say, you know what, you've just created a fiction of a combined company with $500 million in operating income. We don't think this has anything to do with your assets. We think it has everything to do with the target company that you just acquired. I mean, it's going to become a fight in court, and that's what it ends up becoming if it's tax motivated. Okay. Last synergy example is, this has become more and more difficult again to do in the US, but in the late 70s, you know how tax laws get written by Congress, like 1,500 pages, most of which people don't even read, and people slip things in at the last moment, they don't realize it's there. 1979 and 80, this tax law gets passed, or maybe even earlier, it's passed, and somebody slips in a clause, and everybody claims that nobody knows where this came from, which actually allowed companies for a brief period, when they did acquisitions, to write up the value of assets in the target company to the full price paid on the acquisition. You can't do that anymore. Today you got to call accounting firms, they have to reassess your assets, and then the rest has to go into goodwill. But because of the loophole in the law, people are allowed to write up the assets. And one of the mergers that got acquisitions that was done right after this happened was a company called Congolium, which makes floor coverings like linoleum and stuff. And this is actually a private equity deal. Somebody acquired the company, and here's what happened. Because they were able to write up the assets, the depreciation they were able to claim jumped dramatically after the deal. That was the only thing that they did. So if you think about it, the depreciation with their existing book value is $8 million. After they did the deal, that jumped to 35.5. You're saying, who cares? It's more expense. 35.5 million in depreciation with a 40-something% tax rate creates a tax saving of 13.2 million. Just by writing up the assets, that's how much they increased their cash flows by. You discount those cash flows back at the cost of capital. The present value of the tax savings from the higher depreciation alone worked out to 42 million. Pure tax benefit coming from the fact that you have more depreciation. So that's why these accounting firms spend so much time post-deal trying to pump up the values of assets. It's not just because they want a fair value. Fair is not, it's got nothing to do with fair. It's how much can we push up our assets and get away with it. Because the IRS is pushing back from the other side saying, no, you can't do that, you can't do that, because they don't want assets written up. Because they get written up, there's more depreciation, more tax savings. Yep.
Is there a similar bias for these accounting firms than there is with rating agencies? As far as
bias in what's it?
making it more favorable?
There's always a bias doing more deals, right? So if I'm going to call you in, the only problem is you're working with very tight constraints here. Right? So you said ratings agencies. Ratings agencies is actually tougher for you to show the bias, right? Because you can say, well, if you give a higher rating, people are more likely to come to you, but they also have another set of clients. The only reason ratings agencies have value is because bond buyers think the ratings measure something, right? I'm sorry?
Or investment bank. It was just that
No, but it's not. The ratings agencies don't care about investment banks. They really care about their clients, the bond market, and they care about the people who come into the ratings agency to get their bonds rated. So their real concern is maintaining a balance. So my problem with ratings agencies is not that they're biased, but that they're really slow. They take forever to adapt to reality. No. But that's more bureaucracy than anything else. No. So don't pay for buzzwords, whether it's control, whether it's synergy. So if you're going to pay for synergy, at least do the right thing, value the synergy, make sure you're getting the synergy at a fair price. Now let's talk about pricing. In many acquisitions, this has nothing to do with valuation. We talked about valuing the target company, valuing the acquiring company. It's a pricing process. Why? Because you want the deal done, right? You want to get the deal done, you got to pay whatever price you need to pay to get the deal done. So you'll see, just like we did when we did pricing, you'll see comparables and you'll see a multiple. But with all the bias multiplied by 50. In what way? When you have to pick between multiples, you're going to pick the multiple that best allows you to get the deal done. When you pick comparables, you're going to make sure you prune those comparables so that your deal passes the test. See, I have no problem with you doing comparables and pricing, but if I let you use that multiple, I shouldn't be surprised that the deal always looks good. So let's try an example. We take that company that you just valued at 60 million with an intrinsic valuation. At 60 million, the deal's not going to go through. So I'm a banker. I push back. I say the 60 million, that's intrinsic valuation. Nobody uses intrinsic valuation. This is actually a good deal for you. You say, what do you mean? Well, it's 5 times EBIT. That's what other people doing transactions in this sector are paying, based on transaction multiples. So I show you a list of last 5 acquisitions. People paid 5 times EBIT. 5 times EBIT is 100 million. You should pay 100 million. You push back saying, well, that seems a little high. I say, what if I make it an exit multiple? In other words, it's not going to be today, it's going to be 3 years from now. Makes it seem a little less worrisome that it's 3 years out. But it's the same process, right? I'm still taking a bias sample. You see why it's a bias sample? It's a sample of other people doing acquisitions, and we know people tend to overpay on acquisitions, and it's picking a multiple that I got to pick, and I'm applying it to the number that I want to most apply it to try to get you to do it. You still push back, and I give you my final pitch, and this is my trump card. I say, this deal is going to be accretive. What the heck does that mean? What's an accretive deal? It's actually a very simple test. What makes a deal accretive versus dilutive? Whether your earnings per share goes up or not. It is one of the stupidest and most useless tests in an acquisition. Because here's why. A high PE company buys a low PE company. The deal by definition is going to be accretive. A low PE company buys a high PE company. By definition, the deal is going to be dilutive. So what are you telling me? That if anytime I buy a company with a PE lower than mine, I'm doing a good deal? Doesn't it matter how risky the company is, what its growth is? It's a distraction, but it's a hugely used distraction. And it really means absolutely nothing. You can have a dilutive deal that's a great deal. You can have an accretive deal that's an awful deal. Looking at what your earnings per share will do after the deal tells you nothing. Here's why people fall for it. They say, if my earnings per share goes up, my price must go up. In your mind, what are you doing? You're keeping your price-earnings ratio constant, right? So when I buy a low-growth, high-risk company, it is true my earnings per share will go up because it was a low PE company. But if you think the market's going to pay the same PE after I buy this risky low growth company and make it part of me, you're delusional. So when you see this focus on is this deal accretive or dilutive, people are missing the point about what you're getting when you buy a target company. So all those things kick into play, which is when you look at transactions, people are going to throw transaction multiples. They're going to pick a particular multiple. This deal looks good. They're going to talk about accretive and dilutive. Step back and ask yourself, because you as acquiring company are buying a target company, what are my cash flows? What's my value? What am I paying to get that value? Am I getting a good deal? Okay. So what bankers tell you, they have their own agenda. It's not the banker's fault that you're overpaying. You chose to listen and you want to do it because you want to get the deal done as well. Blaming the bankers, I think, is missing the point. It's your stockholders' money. It's your job to make sure you're not overpaying. So now nothing's working, right? 60 million, we're still stuck at 60, maybe 70 or 80 million. I still want the deal to, so I hit you again with my super trump card. I say, you know what? Your CEO really wants this deal done. And then, in fact, that's something we tend to forget. Most acquisitions don't percolate from the bottom up, they come from the top down. The CEO has a dream in the middle of the night that he wants to own a company. Next day, the dream starts to become reality. In other words, top management egos are a big factor in why deals get done. And there's a substantial amount of evidence that accumulated over the last 25 years that the biggest reason for overpayment on deals is overconfident CEOs. CEOs are not just confident, but were so confident that they're convinced that they know things that nobody else does, who can assess value without looking at the numbers. Right? So you'd be told the CEO wants to do it. Or this is the other thing. You have to do this deal because your competitors are all doing these deals. It's kind of a defensive acquisition. Both are really, really, really bad reasons for doing acquisitions. Right? We know that there's winner's curse in acquisition. The hubris drives acquisition. People pay big premiums. We also know that if the only reason you can stay in a business is by consistently overpaying for deals, you know what the signal you're getting is? Get out of this business. If this is such a bad business, the only way you can survive is by doing deal after deal at too high a price. There's no winning this game. Might as well get out of this game. So when you see people giving those reasons, they've run out of all the standard economic reasons. They're trying to get you to do this because if you don't do it, you're going to be at a disadvantage relative to your competition. And as an example, I'm going to take a deal that was done a few years ago. It's HP. Bought a company called Autonomy. To show you how these deals get rationalized. Autonomy is a UK-based software company. It's a business software company. HP bought it for about $11 billion. At the time of the deal, the market cap for Autonomy was $5.9 billion. But just to get the process rolling, here's how HP justified the deal. The book value for Autonomy was about $2.1 billion. The first thing they did was they called in an accounting firm to reassess the books. In other words, they came in to reappraise. They said the assets are being underpriced, come on in. By the time the accountants left, the $2.1 billion had become $4.6 billion. So they added that's so great. You can come in, you add a $2.5 billion value. Okay? The market was attaching a $1.3 billion premium on the post-assessed value. They were paying an extra $5.2 billion and claiming it was for synergy. But no, it was just very This was one of those few deals when HP paid this, their competition all thought they were overpaying. It's very unusual because usually at least it's at least one of the better. This was one where they blew through every competitor. They were paying 80% more than the competition. So Leo Apotheker was the CEO of HP at the time. Was an equity research analyst conference here. And he was asked by analysts, why do you pay for Autonomy? And he said, no, he had actually replaced the previous CEO at a sex scandal. So this is the HP's corporate governance kind of play out over time. So he comes in and he's addressing the conference. I took his words, so I wanted to make sure I'm not misquoting him. Here's what he said. We have a pretty rigorous process inside HP that we follow for all acquisitions, which is a D.C.F based model. Now, I left the dots in there because that's what the news story said. Right? And then we try to take a very conservative view. So he's saying, don't worry, we did a DCF. You know? And it's a very conservative DCF. Then he went on. Just to make sure everybody understands, Autonomy will be on day one accretive. So don't worry about it. It's an accretive deal that we did the DCF on. Just take it from us. We did the analysis at great length, in great detail, and we paid a fair price for the deal. 2 years later, he'd already left. I don't know what happened to him. Meg Whitman had become CEO, and HP announces that there have been accounting issues found at Autonomy. And they would have to write down a significant portion. Remember the $11 billion that they paid? They were saying, look, we think we paid too much. We might have to write down a little bit of it. Well, a little bit of it turned out to be about $8.8 billion. And here's how and when they announced it, they claimed it was all because of the accounting scandals that if it weren't for the accountants cheating at Autonomy, they would never have overpaid. So what I did actually when they wrote off the $8.8 billion is I decided to allocate blame. So I said, let me go through let's see who should be blamed. I attached $4.45 billion of this non-existent premium to the old CEO. So Leo Apotheker should bear, and the bankers involved in the deal. So what I'm saying is set this up for, maybe we should ask for their fees back and Leo Apotheker to pay whatever CEO salary he had. I allowed for the fact that maybe HP is right. There is some accounting issues that accounted for about $2.45 billion of the premium. So the accounting firms that did the Autonomy books should be held accountable for that. The extra $1.9 billion, I could blame nobody but the existing management, which includes Meg Whitman. In other words, I'm saying if you have a big deal go bad, there are lots of different players along the way who are responsible for it. And we have to start allocating blame where it was due and start collecting back fees and money made on the deal along the way. I'm not saying it's going to be easy, but until we start doing it, we're going to see a lot of deals which are destined to be bad deals. Pretty depressing if you think about going into M&A, right? So let me leave you with some optimism here. Let's say that you are a banker and I'm a firm that wants to grow through acquisitions. And I come to you and say, look, I've heard all this bad stuff about acquisitions, but I want to find where my odds are best. So I'm going to give you some choices, and you tell me where you think my odds are going to be better. Is it better to be a sole bidder or in a bidding war in an acquisition? Sole bidder, so that was an easy one. Is it better to go after public targets or private targets? See what I mean by public versus private? Public targets are public companies. Private targets are, of course, private companies. Where do you think my odds are better, and why? How do I acquire a public company? What do I have to do? I have to pay market price plus, right? How do I acquire a private company? It's a negotiated process. There's no market price. We come up with a value. We attach a premium. Where do you think my odds are better? Private company, because in a public company, I'm going to start at the market price. Who knows what's already in the market price? I pay a premium on top of it. Much more difficult. This is a tricky one. Should I pay with cash or should I pay with shares? Which gives me better odds? Actually, the reason I said it's tricky is it's a mixed verdict. For small deals, it's actually better to pay with cash. I'm sorry, better to pay with stock. For big deals, it turns out my odds get much better if I pay with cash. Doesn't it matter whether my stock is overpriced or underpriced? We're going to see that that kind of plays out, because if I do an acquisition and I offer to pay with shares, guess what happens? There's a signal I'm sending to the market, right? When I offer to pay with shares, what do investors in the target company read into it? That I think my shares are overpriced. Otherwise, I wouldn't be paying with shares. And because they think my shares are overpriced, they push up the premium. So the evidence at least indicates that small deals, you can use stock. People don't seem to care as much. So when a Cisco is buying a really small company, they can pay with shares. But if you're doing a big deal, cash deals are better. Small target or large target? Mergers of equals or mergers of unequals? Where do you think your odds are better? Small target, your odds are much better than large target. Maybe for psychological reasons, integration, whatever it is. And finally, is it better, you think your odds are better going for cost synergies or growth synergies? Why do you think that is? Cost synergies are where my odds are better. But why do you think cost synergies are easier? In other words, you can plan for them up front and you can actually hold people accountable for them, right? Growth synergies is much more difficult to do. So when we start on Wednesday, I'm going to show you some graphs to back this up, and then we will pick up on the last piece of this class. Joseph.
Are these the same for if you're private buyer?
It's the same for both sides, yeah.
Has it ever been done or attempted to be done to sell depreciation pass-through securities? It's illegal? Okay.
with